Welcome back to the fundmonitors.com Manager Insight series. I'm joined today by Michael Tobin, the Managing Director of Vantage Asset Management. Michael, thanks for joining me today.
Thank you, Damen.
Michael, I think I want to start today with a bit of an understanding of the differences between Australian and global private equity markets. Vantage, as a manager, invests primarily in investments through other managers in Australian private equity. What are some of the major differences, do you think, between investing in Australian PE and global private equity?
That's a very broad question, Damen, but I think probably the best way to tackle that would be, where does Vantage invest, and then how does that compare to global markets? So our focus is to ultimately invest into companies in what we call the lower mid-market segment of private equity in Australia, and that generally means companies, with earnings somewhere between $5 to $50 million at the time of investment. So enterprise value $25 million through to $250. This segment of private equity tends to provide stronger returns because the time frame for the hold of those investments in the private equity funds is a lot lower. In global markets, you often hear about KKR and groups like TPG, Carlyle, Bain, etc., the big sort of buyout firms. And when people talk about global markets and comparing Australia to global markets, I would often refer to those firms as being, dominating in the global markets. What happens with their private equity investments is they put a lot more debt into their deals. They pay down that debt over time as the company, grows, I would say slightly, and the investment is held for a lot longer. And so therefore, we see that sort of segment of private equity more risky because of those high levels of debt. What we see in our portfolio in the lower mid-market in Australia is very low levels of debt. So as a result, the risk of investing in Australian private equity, I see as a lower risk for investors as opposed to investing in global private equity.
You touched on actually something that I'd read in one of your previous articles, and I think that's the misconception, particularly for private equity, that managers look to find companies with good cash flows and then put some leverage to the balance sheet, cut some costs, and then pay down that debt, hence increasing the value of the business. You don't approach business that way because you're in the mid-tier market. What's some of the differences, or what are some of the things you implement in that mid-tier market to grow those businesses?
Yeah, so our managers are very focused on growing the earnings of a business that they acquire. Whereas at the bigger end of town, those groups that I was talking about before in the global markets, it tends to be acquiring a business that already has a stable set of revenues, or perhaps acquiring other competitors in that space to grow those revenues. And as I said before, putting a lot more debt into those deals, which tends to become much more risky. In our segment, it's about growing earnings. And they do that utilising a number of levers. Often it's really building out the team. So that can be building out the finance function, the ability of the company to actually monitor the performance of the divisions across that company in different locations. And then, of course, introducing new products, new services, opening up those products and services to new geographic regions. I guess a common playbook across our portfolio is to buy what our managers call a very strong platform business, a business that has a unique product, a unique service, or a set of services and products that are doing well in one geographic location. It could be in one state of Australia, or it could be, one region of New Zealand. And then actually replicating that business by expanding organically or acquiring competitors and utilising the positive aspects of that business into the new business that they've acquired to actually take that business to a larger global sort of platform and customer set. By doing so, they're actually expanding the revenue, expanding the earnings, and doing that in that sort of 2 to 4 year time frame, ultimately delivering us a 2 to 4 times return on investment.
So there's a lot of stories of businesses where the ideal is expand or bust to a reasonable extent. What do you do though in those sorts of businesses like you've just described, where they're going maybe from one state to a broader state? What sort of eye have you got to keep on making sure that there's an exit for that business, and you're not just growing a business that you can't get out of?
Yeah. So once again, back to that sort of common playbook, what we find is those businesses that are expanding, and I've got a number of examples where they've started in New Zealand, expanded into Australia, and then getting a foothold into Asia or into the US or into Europe, is then they become attractive to an offshore acquirer. Now, that offshore acquirer could be a larger competitor in that industry sector, or it could be a larger private equity fund or institutional investor, or even in the extreme case, possibly a listing on an offshore market. And by actually expanding into those other regions, it becomes attractive to those other acquirers to then put more capital into that business to then grow it thereon. A good example of that was Genesis Care, which was a cancer care and oncology business that was in our one of our funds, Advent. It was sold to KKR only after Advent had expanded that business across Australia and New Zealand and got a foothold into Asia. Ultimately, that business was sold to KKR. Because of that foothold into Asia, KKR's Asian fund saw that as an opportunity to expand that business in similar way to its expansion plans in Australia into the Asian market, which they did so, and that obviously worked out to be a good investment for that fund as well. So that tends to be a common playbook for our managers.
I suppose that brings to question, what are some of the sorts of situations that can go wrong? I mean, while I think it'd be lovely to get every single investment right, it's not always the case. What are some of the sort of common bad outcomes that can happen in investing in private equity?
Yeah, it's interesting. I mean, our approach is obviously to build a diversified portfolio. Each of our fund of funds has up to 50 underlying companies when fully invested. So as a result, at investment, no one company represents more than 2% of the portfolio. Now, they can grow to become 10 to 15, maybe 20% of their portfolio as they expand over time. But because of that, we obviously diversified approach reduces the risk of investors investing in our fund. Across the 140 companies that our funds have invested in to date, we've only had 3 failures. So I can talk to each of them and perhaps give an example of one of them and how it failed. And one of them was a retailer of musical equipment. It was called Billy High Music Group. Now, this business was invested in around just prior to the GFC. I think it was around 2007. It was a corner shop retailer of musical equipment, and the fund manager made a decision to actually take that business and expand it into a larger footprint for each of its locations. So it took on some debt, took on some long-term leases for those larger facilities that it was looking to actually sell the musical equipment from, and then obviously purchased a lot of musical equipment to fill those spaces. Unfortunately, the GFC hit, discretionary spend dried up, people stopped buying musical instruments, but then they had to meet the debt that was put into that business and also obviously meet the rent that they were paying on those larger facilities that they were selling the product from. The manager made a decision not to put any more equity into that business. They couldn't see a way in which they could actually sort of bring that business back within their investment time frame to make it worthwhile to put more equity in. So in that particular situation, that business failed. Ultimately, it was purchased out of administration by another group, merged with another musical equipment group called Allens, and has gone on to be quite successful. But it was just really a congruence of the time frame across the GFC, that lack of spend, and the fact that the manager couldn't see how they could actually get themselves out of that particular situation. We really avoid that going forward, those types of investments, really focused on investing into funds that ultimately do not put too much debt into any of the deals and not rely on any particular one sort of market segment to actually generate their returns. And so hence that diversified portfolio helps us reduce those risks overall.
The last couple of weeks have seen what we've commonly referred to in Australia as reporting season for equity markets. I'm interested to understand a little bit more about the life cycle of investments in private equity. Are they affected by the sorts of gyrations that we see every sort of February and every August through reporting season? Or are they completely immune to that sort of 6 monthly and quarterly dividend paying process?
Yeah, so obviously private equity is about taking a well-run company private to actually expand it in a short period of time, be it 2 to 4 years. So, of course, there might be some short-term pain when an investment thesis requires that there's redeploying earnings back into the growth of the business, and so earnings may drop over that sort of short-term time frame. Our managers are getting reports from each of these businesses on a weekly basis, so they're able to pull levers very quickly if it looks like one of the businesses is going out of whack and maybe perhaps spending too much money on a particular project that's not going to deliver the returns that they're seeking. So we never really see a gyration in the value of our portfolio because of the valuation swings that are happening in the public markets. I guess we did see a bit of a drop in our valuations in the end of March quarter last year when COVID first hit, and that came about because the international private equity valuation guidelines changed. So instead of being a backward-looking, how was the earnings over the last 12 months, it became a forward-looking, how do you see the earnings of that business over the next 12 months? And in the March quarter, at 31 March, when they had to do their revaluation of their portfolio companies, they were looking at a situation where Australia could have been in lockdown for 6 months, which could have obviously impacted the returns of those companies, or the earnings of those companies. So a number of our managers took a conservative approach to write down the value of those portfolios, in some instances somewhere between 5 to 10%. But there certainly wasn't a massive gyration in value that you see in the public markets. And that's why a lot of institutions globally and a lot of family offices and obviously high net worth now invest in private equity because it has a low correlation to public equity. So when public equity markets are more volatile and earnings seasons are reporting ups and downs across various industry sectors, we don't see those gyrations in private equity. And so that's the benefit of having private equity in your portfolio, because it provides a good balance, has low volatility and a stronger earnings profile, thereby enhancing the total return of your investment portfolio over the term of the investment.
Michael, thank you very much for your time this afternoon. Much appreciated, and good luck for the remainder of the time that your current fund, VPEG4, is open. I think that closes reasonably soon. Thanks for your time, and good luck for the rest of the year.
Thank you very much, Damen. Good to speak to you, and look forward to speaking again.